Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is June 24th, 2020. I'm your host, Arusha Pierce, and today we have Kathy Donnelly on the show. Kathy is a prop trader and author and a longtime customer of IBD and MarketSmith. Thanks for being here, Kathy.
Thank you, Arusha. It's a pleasure.
On today's podcast, we are going to talk about the current markets. We will go over the topic of post-analysis. We'll talk about Kathy's book, and we will end the episode with 3 current stock ideas. So let's get started with the current market. So the market's still in an uptrend. As of yesterday, we had one distribution day on the NASDAQ, 3 on the S&P 500. The market came in a little bit today, but it's entitled to do that. Kathy, what are your thoughts on this market?
Yeah, I agree with you. Market's entitled to have some rest, pull back a little bit. I think it definitely would be healthy to have a couple days, perhaps sideways, before making new highs.
Yeah, exactly.
Hopefully continuing to make new highs.
Right.
But, I like to keep it simple. I look at the big picture. The big picture says we're in an uptrend. You already noted the distribution days. So until further notice, we're in an uptrend.
That's true. And we are at one big round number for the markets right now, 10,000, right? So we got above it. Now we're a little bit below it. So that could be a psychological resistance area for a little bit at least.
Yeah, absolutely. All round numbers seem to do that to us, create some turbulence and really test us and really let us know if we're in the right stocks.
That's true. Now, I mean, this market has been insane the last few months, and so obviously we're entitled for some kind of pullback. What are your thoughts on just this year? I think where we started off the year pretty well, then we had the pandemic sell-off, and then this crazy V-shaped recovery. Have you seen anything like this?
No, I sure haven't. I mean, this is absolutely unbelievable and amazing. I mean, we kept, you guys were great with trying to warn us that this follow through day might not work. We need to be prepared. It might not work, but it's worked.
Yeah, exactly.
So, we were there. I was ready. I mean, luckily I followed my IBD rules, and I actually didn't do a single position, a single try until that follow through day. And then when the follow through day happened, remember, it wasn't even that exciting until the NASDAQ the following Monday. And then I was like, oh man, I got to buy stuff.
Yeah. So the one that wasn't exciting was on April 2nd.
Right.
The S&P 500 we actually got it on, but not the NASDAQ. And so I had my doubts on it. I bought a little bit, but a lot of times when you have such a big sell-off, some of these fall through days are gonna fail. But then we had a really powerful day on April 6th on the NASDAQ, and it's like, okay, maybe we have a shot here.
Right. No, we were lucky. I got to say, I mean, I'm sure you were in the same boat. It was hard to find something. I mean, I told my meetup members, I'm a longtime meetup member as well. There was probably only 7 stocks. I remember thinking only 7 stocks I could potentially buy, and then it slowly got larger. So.
Yeah, and a lot of times that's how it works, right? You take a shot, and I mean, there are a couple of reasons why you take a shot on that fall through day if you see something breaking out. The biggest reason is to kind of change your mindset. A lot of stocks are getting hit. Hopefully, you're on the sidelines, but just doing that act of buying a stock psychologically just helps you start getting more in the buying mode. And if the rally continues, the market slowly pulls you in. So a lot of times in the beginning, there might not be a lot of stocks to buy, but you try 1 or 2, see what happens. And if those slowly start to work and now more start to break out and give you opportunities to get in, you slowly put more money to work.
Absolutely. Well, that's the system, and that's what I did. The same thing, and a lot of the listeners out there did as well.
And I mean, I just the way you said that's the system, I think that says it perfectly, because you want to keep it very simple, right? It's so easy to complicate all of this, and the system is the system, and the sooner you get yourself to follow that system, the better chance you have doing well in the markets or handling crazy environments like this.
Yeah, absolutely.
So Kathy, let's go back and why don't you walk us through how you got into investing and really, kind of the steps that led you to growth investing and becoming a longtime customer of IBD.
Sure, I'd love to. Well, I'm lucky in that I was born with an aptitude for math and science. So I
Okay.
always liked math and science. And I got my degree in electrical engineering and worked in oil and gas for a long time. But really, I have to thank my parents because my parents were both value investors. And they always imparted on me about, of course, going to school, getting a good education, being able to support myself,
Hmm.
and then, look into investing to supplement my income. They would always tell me that's how come we were able to send you to good schools and save money and all those kinds of things.
Hmm.
So really, it was them that, put the little bug in my ear to kind of figure out what to do with that. So I did research value investing. And, my parents were that old school about, holding on and being able to live off the dividends. And anytime a stock split, that was a good thing.
Yeah, exactly.
But when I looked at it for myself, I really took it a step further. Not only did I want to supplement my income, I really wanted to retire from, corporate life of working for somebody else. I wanted to be my own boss and set my own hours and live my own life. So I think that's why I decided to look into growth investing for options so that I could achieve that goal sooner rather than later.
Yeah, and so when did you get started in investing? When did you actually start trying to put some of your own money to work and start that learning process?
Well, that started in college. I started in college. I opened up a brokerage account with oldie discount stockbrokers.
Okay.
It was $50 a trade. There was a guy that said, "Oh, you should buy these stocks." So, I bought these stocks. It didn't work. And then I tried, "Oh, this stock splits. This must be a good stock." That's what my parents said, but, that didn't really work. And it wasn't until I came across a book that profiled some of the top traders in the world. Benjamin Graham, who I think and
Yep.
many of the listeners probably know, father of investing, Warren Buffett, of course, Philip Fisher, and Bill O'Neill, although they were all profiled in this book, and unfortunately in that order. And so that's the way that I researched them.
Hmm.
So I started with Benjamin Graham's book, The Intelligent Investor, which was a very hard read.
But you actually got through the whole book?
I got through it. I probably didn't comprehend or retain probably half of it.
Oh, sure, yeah.
And then I read Philip Fisher's book, Uncommon Stocks with Uncommon Profits. And I really
Hmm.
did like that book. I thought it had a lot of great ideas that, we still would use today in the Can Slim system. But it was more about, actually talking to people in the company and trying to figure out what they were doing. But as a retail investor, we don't have that type of access.
Right.
So it wasn't until I started a new job and moved to the Chicago area where I finally picked up Bill's book. And it immediately clicked with me with the charts, with my math and science, the engineering background.
Makes a lot of sense, yeah.
Yeah, it made a lot of sense to me. And then right away, I went on the internet. I found out there were IBD meetups, joined a meetup right away, signed up for daily graphs at the time, signed up for
Nice.
EIB. I mean, I literally jumped all in like within a month. So
And that's a really interesting
2006.
concept, Kathy, that you brought, because a lot of people in the beginning, they're very hesitant to taking those first steps, or or even taking a step, right? I mean, I think I started out with the paper originally, and then very quickly afterwards did what you did, daily graphs online, and started looking at the blue and green books when I had a chance and things like that. But a lot of people, a lot of times it's that first step that really
Exactly.
gets you to commit, and it seems like you jumping in all in helped with that commitment to kind of force yourself to say, I got to learn this.
Exactly. I really think it's the community that Bill started with his meetups, and this is a community that IBD and Market Smith continue to foster today,
Hmm.
is a big part of it. And so later that year, Bill O'Neill came to the level 3 in Chicago. It was in October of 2006. So even though I was a new investor, everybody was going to the level 3 to see Bill. So I was like, well, I got to go too. So
Yeah, that's incredible.
yeah. So again, just diving right in, got to meet Bill. And then as luck would have it, Jonathan Howard was there and he was promoting level 4. And he was like, okay, the prices are going to go up, but you can buy now.
Sounds like Jonathan, yeah.
Exactly. And we'll sell you, this year's prices for next year.
Right.
And this was when they did it in May and December.
That's right. Yeah.
So
you were one of the first to do that, because I think I only started doing that a few years later. But now first, for those who are new to the podcast, Bill that Kathy is talking about is Bill O'Neill, William J. O'Neill, who wrote the classic book, the How to Make Money in Stocks book, founder of Investor Business Daily. But you were very smart, honestly, to take advantage of that and go and listen to him, because, as you know, anyone who had a chance to really hear him at a seminar, it was life-changing a lot of times, because it really gave you an idea of the level he was at when analyzing a lot of these charts and stocks.
Yeah, absolutely. And when I go back now and I listen to that level 3 recording, it's actually my favorite recording, because what I realize now today is that he actually told me everything I needed to know in that one level 3 seminar. But I just, you couldn't absorb it all. There's just so many pieces. But I do have a favorite quote I wanted to share with everyone from that seminar. And it goes like this, and it's also related to a post-analysis that I'll be talking about later. But it was repeat, practice, rehearse, over and over until you know it backwards and forwards. And he said, that's how you get it down pat. And, that's what it is. And that's my tie-in to post-analysis, because that's how you kind of have to, look at what you're doing, figure out if it's something you should repeat. And if it's not, change it, practice, and then move on again. And that actually also reminds me of Bill's certainty story, because really, that's how he came up with the rules. He had to, he bought the stock, he knew he missed out, and why didn't I miss out? So he studied, and then realized, oh, well, I need to have an 8-week hold rule. Created the rule, and then was able to hold on to Syntex later, and, created IBD. So I just think it's amazing.
It's true, I remember the first time I went to a seminar with Bill, it was in 2002 in New York, and the one thing, it was not only just amazing just to see him analyze charts and things like that, but just the way he encouraged, just like your quote right there, right? Just the way he encouraged and it was so positive, but also realistic. Hey, look, you have to learn from your mistakes, and honestly, for me, that was one of I didn't hear that often, right? Usually when mistakes, you're taught that they're bad, and right. Here it's like that's the key. You have to go back, look at these previous trades that you made mistakes on, and learn from those mistakes. And then slowly over time, you'll start correcting it. A lot of people want it immediate, but this really, and you're a testament to this too. It's the ones who really get this down and get better and better at this are the ones who just hang around long enough.
Yes, definitely. Well, I have to say, it's my number one key to success is doing post-analysis and learning from my mistakes and practicing and getting better. And really, that also relates to my engineering background, because, whenever there was an incident, or an accident, whatever you want to call it, we had to figure out what was the thing that caused the incident,
right.
And we called it root cause failure analysis. What was the root cause of that initial, mistake? And, even you can even tie that to Bill's buying right. If you can buy right, you eliminate all the other problems.
It's true.
If you just fix that one thing, buying right, and then whatever the next thing is. Yeah.
And it's with the engineering background, I've seen this a lot. And I applaud you for graduating and being an engineer. I started out as an engineer in school, and I lasted a semester. So I was the first person to quit engineering school, and run back to the liberal arts college at Tufts University. But the one, I was a science major, and those charts really resonated with me. And I think for a lot of investors, it doesn't make sense. It looks like tea leaves and things like that. But in many ways, the charts, they're telling a story, and it just gives you a plan in place, right? And gives you a sense of the direction.
Yeah, absolutely. Well, I think the good and the best analogy, I mean, I guess I'll be talking about Bill the whole podcast, so it's a good thing you let everybody know who Bill is.
Exactly.
But yeah, I mean, it's the EKG, you know, for somebody's heart. And that's what this, you know, if you can read that, you can figure out what's going on.
It's perfect. So the market's in an uptrend, but we could be due for a pullback. I mean, this has been an amazing rally the last few months. So don't be shocked that we get a pullback sometime soon. Of course, I've been saying that for the last couple of months too. But remain disciplined. That's the key. Don't chase stocks, because you don't want to get caught in the pullback and find out the hard way why we don't chase stocks. So let's take a quick break. But when we return, we are going to talk more about post analysis, and then we will get into the book that Kathy worked on and is one of the authors, The Lifecycle Trade. So stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, stocks near a pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Kathy Donnelly is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Kathy, let's get into post-analysis first, and then we can get into your book too, and go over some of the lessons there with a number of the IPOs. But let's first talk, I mean, and you've already started talking about the post-analysis. Let's get into a little bit more, and maybe how you benefited from post-analysis here.
Oh yeah, absolutely. I'd love to. So the post analysis I'm going to share is actually going to be from one of my first trades that I made in 2006.
Intercontinental Exchange, right?
Yeah, Intercontinental Exchange is and that was the year I started trading. And I shared this post analysis in 2010 with my meetup members. So I started a meetup in 2010. It's actually my 10-year anniversary. So
oh wow,
yeah. So I love my meetup members. They're great. So hi, meetup members.
Meetup members.
Anyway, so I actually did this presentation. This is the same chart I used and to show them, you know, how I learned from this trade. And so, as luck would have it, it's foreshadowing. It's also a recent IPO, which is what we did a lot of our research. What we did our research on for the Lifecycle Trade. Right. And like a lot of IPOs, it had a prior run up. And then it created a big first stage base. And it looks like it was in conjunction with the market there. And I bought it right at the buy point from the handle. But what I did wrong was I sold it like 2-3 days later on a shakeout below the 21 EMA.
Okay. You know? Okay. You got shaken out there.
Yeah, right there.
And I think this is, you know, because this has happened to me tons of times. I feel like I've slowly gotten better at handling some of these things, but one of the ways that helped me is this time frame right here, right? Okay. The weekly charts, where on a daily chart, when they're really selling off, they look really scary. But on a weekly chart, sometimes even on that sell-off, it puts a little bit more perspective, because you see this monster run over here, you see a previous run up here. Oh, maybe it has a little bit more of a chance.
Yeah, exactly. But I mean, the only thing I remember for sure is that I think I was just scared.
There
And
is a lot of emotion.
Yeah,
sure.
and I just sold it. I
Yeah,
really didn't have set rules yet. I was still just learning the system. And see, this was this happened. This was, I guess, at the end of 2006. So I might have already or not even gone yet, Bill's level 3 yet.
Okay.
And yeah, I didn't know what I was doing. Clearly I was wrong. I saw it going up. And so then I just like bought it again on a gap up. And that actually, that one wasn't too bad. It actually looks like I made a little bit of a profit.
You did pretty well there. Yeah.
But then I just sold it. And again, I think for no reason. And then, I mean, I don't know, maybe I mean,
that's a pretty good profit you had there.
That was pretty good. But then what happened after that? Then I bought it and sold it, bought it and sold it, bought it and sold it like 4 or 5 more times.
Yeah.
When really I should have just been holding it and then just selling it when it broke the 40 week. And so I only made 1.5%, and I traded it like 20 times. And I have all these trades here for those watching the video. I mean, how sad is that?
No, this is classic. This is I've done this plenty of times, and it still happens. But this is really just a classic because you feel like you have to do something all the time.
You do, right? Mm-hmm. So what I've learned from this is that, well, if I had just bought it where I initially bought it and did not sell it until it broke the 40-week line, I would have had a 70% profit.
Wow. And so the 40-week line here is the black line on the chart. And this is a much more longer term moving average. Usually we're going to use the 10-week line for most with the system, the CANSUM system or growth investing system. But the 40-week line is the primary trend of any of these stocks. And so that's the one that if any stock really, really breaks that, then it could be in real trouble.
Yeah, when I'm going to so many level 4s over the year and so many seminars, I would be sitting in the audience and you guys would be showing these monster TMLs, true market leaders, super growth stocks. And they, you'd be like 500% gain, 400% gain. I'm like, well, how are they doing that? Yeah. And I kept looking at the top of the chart, and you always cut off the chart, usually when it was breaking the 40-week line. So that's actually literally how I came up with that. I mean, there's the 10-week, and that's legit, most people don't want to take a drawdown. But because I had this goal of 100% or more, 400%, I was like, okay, I gotta go longer. I gotta go 40-week. And, once you have a 50, 100% gain, Bill always said, well, you can treat it differently. And basically I treat it differently, and that's how I treat it.
That's excellent. And I agree. I think the super critical line is that 40-week line. If you have the ability to withstand some pretty decent sized pullbacks. Now the classic way that we've all learned was we ideally want to try to build our positions into 20% positions. Have you adjusted that when using the 40-week line, or using smaller positions to help you handle those pullbacks a little bit better, or how have you adjusted, or have you adjusted?
Yeah, well, basically the way I adjust is that and I'll use 50%, 40 to 50% is kind of like where I break it up. If I am having trouble getting to 40, 50%, then I'm taking the 20, 30% because I just can't get any more out of it.
Okay.
But if I'm already have 50 to 100, then I'm just, I can treat it differently, and then I'm using that 40-week line. And one of the things I'll talk about a little bit more, but I'll just go ahead and get into it now, is one of the things we talk about in the book is not only IPOs and how to kind of look at them, but also a way to strategize your portfolio by creating a mental capital preservation stock. And the best way to explain that is basically just how much profit do you want to retain? Do you always want to retain 50% of your profit, 40, 60, what's your level? And what I have found out for me is my level is 60%. So once I have that 50% gain or more in a stock, I want to retain 60% of my profits. And usually I can do that easily, and the 40-week line will usually come they trigger at the same time.
Oh,
So
wow.
if I get a 40-week break, it's usually right where my 60% is, and that's just where I cut it. And that's
Okay.
like my long-term sell rule. If I can get to that point, I have a stock that's 100% or more.
That makes sense. Yeah, I mean, at least for me, a lot of times I'll go through that kind of exercise, but then once it starts coming in, I'm just like, forget it, forget it. I'll take my profits now. So that's, I mean, that's good that you're very, very disciplined like that. And in the end, that's the way to do it. You want to do all this thinking ahead of time, and then
Right.
stick to those rules, right? Because a lot of times, I'm sure you found out that, hey, it didn't even get down there. It found support and then just went up even much more, right?
Right. Yeah, it's really interesting. We talk about the first touch of the 10-week, usually guaranteed. I mean, we don't want to say anything's guaranteed, but usually odds are in your favor. And then after the other touches is when it starts to get more risky. And again, since I've studied these long-term charts for so long, I've also noticed on the really big leaders, they'll touch the 40-week like one time before they're like really done.
Yeah.
And then the second time is usually, okay, it really is done. So it's really interesting.
And okay, so we've seen kind of the classic thing that that everyone goes through. I think you have this once you learn how to read charts, or once you really start focusing on charts and you watch stocks too closely, you're just tempted to do something. So what you showed us there is absolutely classic. Now should we transition to the IPO, the books? Do you want to do that, or do you want to go over the Twilio example first?
Well, we can really do this. We can do it with either way, because actually, with ICE that we just looked at, it was a recent IPO, and it had that initial advance like most IPOs have. And what we found in the book is we just call that the advance phase. And most IPOs do go through that. And then it even had just that short, big base, which was a short, but a due diligence phase. Most stocks will go, recent IPOs will go through an institutional due diligence phase. And you'll see if you're watching the video, I've got it abbreviated here, IDDP, just because I was running out of room, because it wasn't that long.
So yeah, this is the DDP, the due diligence phase.
Yes.
So you have your strong run up initially.
Yes.
Now it takes time off. So that's the due diligence phase, talking from the perspective of the institution, right? They're doing their due diligence on some of these companies, right? And a lot of times they'll form those kind of larger bases, the first stage.
And in some cases they might be waiting to see, when they're actually going to have earnings. A lot of IPOs, as we have good revenue, but we don't have earnings yet. And it might be that earnings that actually is what catapults it and then starts that institutional advance phase.
Right.
And
right.
And if I had known that back then I truly would have known to just buy and hold, and then it was done here, soon after, like we already talked about.
Right.
So in the book, we talk about these different phases, and when we look at the next stock, I'll show the same thing, but it's definitely something that I focus on, because to me, that institutional advance phase is the most rewarding phase of the stock.
Mm-hmm.
And I think it matches up with the CAN-SIM system, because the CAN-SIM system also wants you to go get that first stage base. And we're just saying, and really focus on those first stage bases after that due diligence phase.
Yeah, and it also matches with the CAN-SIM system in that a lot of the very best stocks using the system are newer companies.
Absolutely.
Right? And a lot of times companies that you don't even recognize the name of.
Yes, exactly. The newer companies. So so it's perfectly in line. So no surprise, since we're all CAN-SIM devotees, that it makes sense to us.
Right. So do you want to go over Twilio now? Let's
talk about
so
Twilio.
I just switched over to the Twilio chart right here. And Twilio is a stock that it once again is doing really well, but this is back in the end date here is September 16th, 2019. Walk us through this.
So this wasn't that long ago, right? And we're going to talk about Twilio later. It could be coming back. But, this is a perfect example that I want to share with the viewers, is that this had an IPO advance phase like ICE did, but this one was over 100% or more in 90 days.
I remember that, yeah.
Yes, and I did not trade that at all, unfortunately. That's one thing I'm not as good at, is the faster trades, because again, I like those longer, like the institutional advanced phase, where I don't have to, be watching it so closely, not as much volatility.
Mm-hmm.
But this one, what we found in our research in the Lifecycle Trade is that stocks, IPOs that make 100% within 90 days are twice as likely to go up 500% or more.
Wow.
Yeah. So even though I missed that 100% run, this was on my special watch list to say, okay, well, if this comes back, this has got some real potential.
Yeah.
So you'll see here, its due diligence phase was much longer than ICE's, about, over a year or so.
Yeah.
And
which I mean, that's normal though, right? For a number of these stocks. Yeah.
Yeah, absolutely. And it created a bottoming base. And I actually tried it when it first got back above the 40-week, but it wasn't ready.
Here.
Yeah. Well, a little bit more to the left there when it first.
Over here.
Yeah.
Okay.
Yeah.
Okay.
I was kind of playing with it there, and it didn't work. I was just trying to get in early.
Which is fine, Yeah.
Yeah.
I mean, yeah.
But,
Don't tell Bill.
But not every trade's going to work.
That's true. In the end, as long as you manage your risk, and if you've proven to yourself that you can manage risk, in my opinion, that enables you to take more, kind of stretch it a little bit, because
Right.
you're not going to, usually you're not going to put yourself in a position where you can get yourself hurt.
Right. And that's why, we have the 8% hold rule, sell rule. So.
Exactly.
Yeah. So then, fast forward, it came back above the 40-week line, had a great earnings announcement, and that's what created that big blue bar.
Yep.
And that's where I was buying it. And I was buying it all around there, and when it actually hit the real buy point. And then essentially I held on to it from there. And you'll see in this case, it did break the 10-week. It never touched the 40-week until the very top there.
Yeah.
And that, with my learning, right, from ICE and my style, and I was fine with that volatility because I already had such good gains that I was okay with that. I knew that a true market leader could respond in this way. And at that point, I was just waiting for a 40-week break, and then also making sure to retain 60% of my profits.
That's a great trade. I mean, and I just switched it to the next slide here. So 250% profit, right?
Yeah, and that's really from the initial buy point, and then of course, like I said, that I added some. So this definitely goes into one of my top trades of, well, I don't know if of all time. I guess of all time. Why not? Of all time. Since we did the research on the book, this is definitely one of my best examples of what I learned doing the research and how I was able to apply it. And of course, keeping up with my post-analysis to continue to learn.
No, and that's excellent. So when we and actually, you know what? Let me just show this last slide here, because you have this nicely marked up too. So next time we do a presentation and I show. So there's your buy point, and that's where your sell point is. So next time when we do a presentation, whenever we start going back out around the country, and I show Twilio and I show a 250% move, I can say, well, Kathy did it. Because a lot of times, and for me, I was in this move a number of times, and that comes down to your personality, and that was something that you said initially too. That's very important, I think, for listeners to get, is that initial move. The first 90 days was really fast moving, and Kathy, you knew that you just don't handle that volatility as well, so you didn't play as much in that one. And
Exactly.
You really waited for your sweet spot.
Exactly. What I also want to share with everyone is that I did sell it. I followed my rules, but it was hard to sell. I didn't want to sell it. It was a good stock to me, obviously. And I, in the back of my mind, like, oh, but what if it keeps going? What if it just jumps back up? And I didn't want to sell it. I mean, selling, even doing this for as long as I have, and you have, I mean, it's still hard.
Very hard. Yeah.
You got to have your rules.
Yeah, I completely agree with you there. It's it is something that I still continue to find very, very difficult, especially selling into strength. But yeah, when you have a huge winner like that, it's always, it's always tough because it's still in the back of your mind. What if you made 250+% in it? What if it went at 500%? What about 1,000%? Right? So those kind of things just go through your head. But yeah, I mean, there's a point. I think the biggest thing is that you made some rules, you had a plan, and you actually followed your plan, and that's. If anyone, everyone out there listening, if you do that, you will see more and more success.
Yeah, absolutely. I mean, like I said, it's the number one key to my success. And I understand selling is hard, but we've got to have the sound rules. And the more you can figure out what the first thing you did wrong is, that'll help, I think, in the long run. Because you don't want to fix something that's not really a problem.
Right.
Figure out what that first thing. It's like what Scott O'Neill always says, know thyself, know yourself.
That's true.
So so that you're, trading for within your personality. And then I would just say, keep your eye out for those first stage bases right after that due diligence phase or after that IPO disease or whatever you want to call it. Because likely that'll be a really great run.
Perfect. So post-analysis is critical to becoming a better trader. And understanding where a stock is in its life cycle, too, is a huge step that you want to get down. So coming up next, Kathy and I are going to discuss a few stock ideas. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back with Kathy Donnelly on Investing with IBD, sponsored by MarketSmith. Okay, Kathy, let's get into a few ideas. And the first stock that we're going to get into is Spotify. And the ticker symbol is SPOT. And so if you're listening to the podcast, or if you're listening to the podcast, when you go back home, definitely go to investors.com/podcast, and you can see the video version of this and where we're pulling up some of these charts, and also Kathy's slides on some of her trades, which have the markups too. So here I pulled up Spotify on a daily chart. And Kathy, what do you like about this?
Yeah, this is great. Can you put the weekly on?
Oh, I like that.
Yeah,
See, everyone always starts on the daily. Yeah, exactly. You have learned very well, Kathy.
Yes, I'm much better with daily charts these days, but I really try to do my best to be like Bill and always start with the weekly.
That's excellent.
So here's Spotify. Now, if this was a stock that I purchased, which actually it is a stock that I have purchased, if I were doing my post analysis, I would screenshot this weekly chart, and then I would screenshot the daily chart, and I would actually open the window for the alerts. So I would get my alerts of where I bought it and other things that I'm watching, and I would screenshot the daily. Okay. Yeah, it's really nice.
So you actually take. So you'll set the alerts, and then what do you write a note in it too? And,
yes,
and then you just
absolutely.
And then you open up like the alerts panel here.
Exactly. Yeah.
Oh wow, look at that.
Look, you got some alerts.
I know. I do have a position in Spotify, and I've been watching it for a while too. And so here are some of my alerts that I haven't deleted yet. But
so see, I would take a screenshot of that, but on the daily, the weekly, and then the daily with the alerts, and then I would also screenshot the monthly. And with the monthly, I would show the other pane with the institutional ownership.
Oh, very cool.
Yeah, so that way I really have a picture of what it looked like when I bought it. Yeah, exactly. So then I know what O'Neill funds are in it, and the fund sponsorship over the last 8 quarters.
That's excellent. Wow.
And I would put that in a PowerPoint, and I have a PowerPoint for every year. And then every time I buy or sell, I would take those same 3 screenshots. So that way I can easily take notes at the bottom and, see what I did wrong or what I need to change or whatever.
That's perfect. And I think I might have seen in an email. I don't know where I got. Maybe it was an email. Maybe you sent a while back or something like that. But you like putting the notes in PowerPoint after putting the screenshots because it enables you to search through those files a lot better, right?
Yes, exactly. I put the name of the stock so I can search on that stock symbol and make all the notes. And then, and then I always have it. The only, I do use the note feature in MarketSmith too, for certain things. For stocks that actually I don't own, that I just want to keep notes on.
Oh, interesting. Okay.
Yeah. Especially fund sponsorship mainly. I like to keep track of changes in fund sponsorship. So I use that feature.
Oh, very cool.
Yeah, so that's how I would do it if I were doing a post analysis or just keeping track so I could do the post analysis when the trade was complete. But from a lifecycle trade perspective, Spotify had a nice little first stage IPO base there and a little bit of nothing too dramatic. We didn't have that 100% run like we saw in Twilio.
Right.
And then like most IPOs, it undercut its day one low and its first base. And over 90% of the IPOs will do that. So that was really expected, not surprising at all. And I think, everyone knows that. And then it created this nice, crazy double bottom. I mean, I haven't seen a double bottom like that.
It was a crazy double bottom for sure.
Yeah, you don't see them that long usually very often. And so I had traded it similar to when I was talking about Twilio. When it first kind of came back above the 40-week, I was kind of playing with it, and it clearly didn't work and created that first drop, that first part of the W.
Okay.
And and then I tried it again, and then it, made the second part of the W.
Yep.
And then it broke out again on earnings, just barely, right, and reversed. Yep. And I got shaken out of that. And then when it really went, I didn't buy it.
Okay.
So that happens.
Mean, and this is beautiful because you're willing to share this, but this is what everyone goes through, right? You just don't do these things perfectly, but you have to learn to acknowledge and accept that you're going to mess up over and over again. And the most important thing is, if it does something differently, if it starts going up again, then you have to find a way to get back in it when it gives you a chance.
Yeah, absolutely. So, so it created a really nice institutional due diligence phase, like a year and a half. That's really good. And again, that's what we call that. And it's past what we call the turbulence zone. So that prior high from that initial run up from its IPO base.
Okay.
And so it's powered through. So clearly it was having trouble getting past that new high. And so, if that was expected. And, it still doesn't have good earnings yet, unfortunately, but it's got great sales. It's got that great news that now it's going to have the Joe Rogan experience, and now they're going to have Kim Kardashian. So, everything's on their side right now. Right. It's definitely on my watch list if and when I need to weed and feed or look for some new stocks, but luckily, knock on wood, I think I'm in some of the leaders. So, I can't get them all. So, but it's on my watch list. It'll be something, that, because it looks great. I mean, it's clearly, if you already have it, it's a hold. If you want to get into it, we're going to have to wait for another base, but it looks really good right now. Yeah,
I have some shares of it, and like you, Kathy, I had it. I tried it a few times too, and then I just got unnecessarily shaken out of it when it came back in, because I'll switch to the daily chart.
If you think about it, I mean, that was when we started having volatility, in the market, and then we didn't know if the follow through day was going to work, right? I mean, we'd have to look at the exact dates, but I was casting a wide net. I mean, I'm sure you were too, and you can't hold on to all of them.
Yeah, and that's true. You're absolutely right. You're not going to get everything, but I think I got shaken out, kind of like where you were here, just being careful. And but then when it went again, that's when I started getting some of it. I didn't get a great position, and then I just added a little bit on here, but I don't have a great position in it right now. But these are, and I'm sure you're thinking the same thing. These are one of those stocks that it was out for a year plus, and it also just had this interesting story. It's like, wait, a lot of people are using Spotify. Maybe they haven't necessarily proven that they can make money yet, but it just seemed like they were starting to capture more of that podcast market, and that podcast trend is just going through the roof right now. So
especially now.
Yeah, exactly. And it almost, and I'm not saying it's anywhere near the company that Apple was, but remember when Apple they, it was, remember when it was like Napster and all the free kind of music sharing and stuff like that. And you even knew then, everyone knew then. It was like, okay, whoever can figure out how to capture this market and monetize it, they're going to make a killing on it. And it was Apple, right? And then I don't know if anyone really truly realized that Apple couldn't capture the whole market. You thought there might be a few players, but Spotify's kind of going for that in this market. It's just seems like everyone's listening to podcasts these days, and they're going for it and trying to get some exclusives and things like that. And the biggest thing is Wall Street is getting more excited about it too, and you can just see that by the buying in the stock.
Yeah, I mean, that volume looks great. Those price bars look great. I mean, for me, Spotify is a great tool for me because, I'm not Mike Webster. I don't know who sang what song or who, what band. I don't. Right. I know the song, but don't ask me what the name of it is or who sang it. So I need Spotify and I need them to help me build my playlist. I go to some fitness places. Yeah, I go to this one fitness place and they do all their playlists on Spotify. So if you went to a class and you like their playlist, you can follow it and now it's your playlist.
No way.
So it's perfect because I can't create my own playlist. So I just have people follow theirs, or I have people send me theirs.
That's really interesting. I had no idea, but that's so they do have that really big social aspect in it, and that's really cool to know. And this is, they've been doing that, the social kind of, and they're one of the first ones, I think, in the music kind of space to do that. And they've been doing this for 7-8 years now since they really came out. And obviously you're just seeing the results of that kind of inch by inch, slowly getting everyone into their ecosystem.
Yeah, exactly.
Okay, so let's go to the next stock, and this is Ping, ticker symbol PING, and Ping Identity Holding, and they are yet another security stock that's doing well in this market. And Kathy, I'm going to go to the weekly chart first, so you don't have to tell me to go.
Great, thank you. You were reading my mind. So yeah, this is another one I've been watching, especially since it's a recent IPO. And this one, unlike some of the other ones we've seen, actually does have earnings.
Mm-hmm.
So this one was definitely attractive to me from that standpoint. But one thing I want to highlight, and I'm sure you know this, is now it's a $20 million. Now it has $20 million liquidity, so price times daily average volume.
Right.
But really, when it first came out, and even, it only just recently, maybe a month or so, did it actually pass that $20 million liquidity level. And so,
go over the importance of that.
Absolutely. Thanks. So yeah, we found in our research is that institutions, the stocks that were really the big winners were at that $20 million mark. That's the level that institutions, like a minimum, would really want to have. And so that's the level we created when we were trying to figure out what level to go down to research all the IPOs to see how they performed. And so that's really how we came up to it. And it's just so that we know that we're buying stocks that the big institutions will buy as well.
Perfect. And okay, so now with this one, walk us through, just using the Lifecycle Trade lens on this. Walk us through the different phases that you see in this stock and where it is now.
Yes. Okay. So you had your first stage base, IPO base. I don't know if Mark calling that a first stage base? Yeah.
Yeah, so it's calling it a cup. Yeah, it is a first stage base, but it's calling it a cup instead of an IPO base here.
So officially it didn't have an IPO base, but it had a first base there pretty much immediately, within 4 weeks, 7 weeks, something like that.
8 weeks. Yeah.
8 weeks. So perfect. So normally, that would be something viable. Can Slim system, our system, the tweaking of the Lifecycle Trade, you'd want to purchase that. But because of the $20 million liquidity level, I would be hesitant to purchase that.
Okay.
But it had a nice initial advance. We call that the IPO advance phase. And then it undercut, and it looks like it undercut the base low. Did it undercut there?
It did. Oh yeah, it did. Yeah.
So
it had a nice reversal once
yeah,
it undercut on that.
it had a nice
week.
reversal, but
Right.
it did undercut. And as I said before, 90% or more of the IPOs are going to undercut. So again, that was expected. And not very long. So this actually is what starts the institutional due diligence phase I was talking about. But in this case, it's very short. I mean, we didn't even have 40 weeks, and that's kind of rare. And maybe that's a function of the market. And because it was less than 20 million, I will say it was more than 10. And I actually do screen IPOs between 10 and 20, because sometimes when they actually do like have their breakout on like really big volume, it like officially converts over to the 20 million. And then if you're not like there, then like you miss it.
Yeah.
So I was like watching it, because like sometimes I'll be like this really great stock and it's liquid. I'm like, well, why did I miss this? And it was because it was so illiquid at the beginning.
That's interesting.
Yeah. So I was definitely keeping my eye on this, and I actually bought it right as it went above the 10-week line there.
Okay, over here.
After that big drop, but the volatility was just too much. And I looked at the calendar when I bought it. It was the second, we were barely 2 weeks in to the fall and the new wrap.
Makes sense.
And if I was, I was speaking of that wide net, and it was just one I couldn't hold on to. And so I let it go. But now it's over 20 million, and, security. Yeah, I think computer software security is going to be in vogue for like ever.
Right, exactly. Since
I mean,
it seems like
it feels like.
Yeah, I mean, it seems like anyone who's working from home now, they're never going to go back ever to work. So we're going to need more security.
Exactly. So it did go past its previous high that it had from that initial IPO advance phase. So it's kind of past that turbulence zone. It looks like it's still going to have a hard time, and that could be because it's still, I mean, it is over 20 million, but there's still seems to be a more volatile stock. I would say it's extended right now. We'd have to wait for another base before we'd want to get into it if we weren't already in it. But the RS line's at a new high, and it looks like we've got good fundamentals. So
yeah, and I'll just quickly switch over to the daily chart. And I mean, for me personally, when I just look at this chart, I already know that I'm not at this point. I'm just not going to do very well at it. I can't handle that volatility.
Yeah, same here.
So for this is a company where I would personally let it settle down a little bit, maybe trade a little bit more, or come up with a little bit more traditional base, or find some other security stock that fits your style or something. But I mean I have a few already in this category because it's right at the top of the list. So if you're really following the system and paying attention to some of these what's coming up on the screens and what stocks have broken out, you're probably finding yourself at least having a chance to get into some of these.
Yeah, absolutely.
Okay, and so let's go into the third stock, and that is Twilio, which we spoke about in 2019, and you had your 250% plus run at that point, and it was hard for you to let go of it, but it's back.
Well, look at all those alerts you have.
I know, because I do own this, and I
outed you.
You have outed me. Twilio is a stock, and I've spoken about it a bunch, at least on IBD Live. But this is a stock that I owned back in that initial IPO stage. And I just like the story of it.
Oh, you've had it all the way from the IPO base?
No, dear God.
Oh, sorry.
I'm not like you, Kathy.
Oh, wow.
I don't have the patience of you. No. Like in that first initial run, it was up. Yeah, I think I was only in it for a few weeks because it ran up so much, and it was like, this is just ridiculous. So I took the gains and ran at that point, and then I did not. I mean, I was in it during when you did really well in that, but I didn't do great in it because it got way too choppy for me. But I'm in it now, and I've been in it since the earnings gap here, and so far so good.
High five.
Yeah, exactly. High five.
I have it too. I have it too.
Okay, good. Yep. And so walk us through where you got back into it, and what you like about it. And
yeah,
you know what?
well, let's go to the weekly.
Yeah, exactly.
Yeah, so this is so great. So this is why I wanted to talk about it, because I traded it before, and then, as you know, I mentioned earlier, I pretty much sold it at that first break of the 40 week, and clearly it was a good move because it stayed below for a long time, and then it even went lower during the coronavirus bear market, and so it was a good play. It still has great fund IBD mutual fund ownership, so we like that. And really, there's no mistaking that gap up bar and that volume, right? I mean, that's like a core clear spoke. I don't know what I'm trying to use a cool analogy, and but I mean,
it's a skyscraper, right?
It's skyscraper. I mean, big volume, big price gain, and earnings, viable gap up, whatever you want to call it. And it has the news behind it about the coronavirus. Now, granted, it doesn't have the earnings it did, but I mean, that's part of the comeback that it's creating. And so like you, I don't think I actually bought it on the gap up day, but I bought it the next day. And I basically kind of tried to look at some levels from some intraday charts and kind of tried to figure out a range in there. And basically that's how I bought it the following day.
Oh, perfect. Okay.
So yeah, so I have about a 20-30% gain, I think. And, it looks like it created a nice little flag right there.
Right.
And so slightly extended now. We'll see if it's going to pull back and maybe create more of a base. Hard to say, but right now, it's below that 40% that I told you about. Like I don't have a 40 or 50% gain yet.
Oh yeah.
So, this one's going to have a little bit tighter rein. Hopefully we see some nice action around the 10-week line. Maybe the 10-week line ignites it, gets to up some more. But clearly the story's behind it, and I think it looks really good.
Yeah, it's I think and when Jim Ropel was on a few weeks ago, this was one of the stocks that he spoke about too, and it was just that monster. Pay attention to that monster volume, which and that's from Bill right there.
Right.
That's he was always highlighting things like that in the seminars, and just that big skyscraper. Then you have to pay real close attention to it because there are a lot of funds at that point that are trying to accumulate more of a position.
Absolutely. And I think if we look at there, we've got it up there, the fund ownership over the last quarters. I mean, it looks like every quarter you've got acceleration. So
that's true. Yeah. So Twilio is one to keep on the radar. In the end, right now it is kind of gone. So let it set up again. And I've been saying this forever, but one of these days the market is going to pull back, and they'll pull back for a couple of weeks or so, maybe even longer, and give us a chance to build more for stocks to build bases, and give us a chance to get into some of these ones that we might have missed too. So there are a few ideas that are worth adding to your watch list, and so definitely consider them, and keep an eye on them over the next few months. They'll probably give you a chance to get into them. So thanks, Kathy, for joining us today.
Yeah, thank you, Rusha. I really appreciate it. And I also just want to, say thank you to Bill, Scott O'Neill, and of course, all of the Investors Business Daily and Market Smith team. Your dedication to helping others is really amazing. And, that's why I'm still a meetup leader, because I want to help others. So keep up the good work.
Thank you. And then thanks for being a meetup leader. I mean, that we've definitely seen people, we've seen people really improve by sticking with the meetups. And Amy, I worked with Amy Smith and a number of others in the Santa Monica meetup for years, and so I have a taste of how much work it takes to keep those going. So 10 years, that's quite an accomplishment there. So
thank you. Yeah, well, I got great members, so.
And next week we will have Lisa Chai of Robo Global joining the show. Lisa is a senior research analyst at Robo Global and is an expert at identifying disruptive technologies. So that's it for this week on Investing with IBD. I'm Arusha Pierce, and thanks for listening.